Every country on Earth carries debt. The United States owes tens of trillions. Japan owes trillions. Globally, total debt now exceeds $300 trillion, far larger than the entire world economy. That fact alone feels unsettling. But the real question is simpler and far more disturbing. If everyone is in debt, then who is the world actually indebted to? When you trace the chain of ownership, something strange appears. Governments owe money to banks, pension funds, insurance companies, and central banks. Those institutions, in turn, hold each other's debt. Nations owe themselves through trust funds. Central banks hold government bonds. Investors hold bonds backed by taxes paid by citizens who are also investors through pensions and savings. The system folds in on itself. This isn't about secret control or hidden cabals. It's about how modern finance evolved, step by step, across centuries. Each change solving a short-term problem while creating long-term dependency. A system where debt is not meant to disappear, but to persist. Before the modern era, government borrowing was temporary. Kings borrowed from merchants or nobles. If they failed to repay, creditors lost money and lending stopped. Debt cleared through repayment, or default. It was messy, risky, and politically embarrassing, but it ended. That changed at the end of the 17th century, when England was at war and desperately short of funds. A proposal emerged that would alter how governments finance themselves. Instead of repaying loans, the state would commit to paying interest indefinitely, backed by its power to tax. In exchange, lenders would receive a stable, transferable asset. This arrangement led to the creation of the Bank of England and the idea of permanent national debt. For lenders, this was transformative. Government debt became a reliable, long-term income stream rather than a risky wager. For the state, borrowing became easier because repayment was no longer expected, only servicing the debt. Over time, government bonds became foundations of financial systems, used as collateral, savings instruments, and risk-free assets. As Europe industrialized, another shift occurred. Sovereign debt became tradable on a large scale. Bonds could be bought, sold, and resold across borders. Ownership spread through banks, funds, and investors in multiple countries. This made government debt liquid and attractive, but also deeply interconnected. Default was no longer a simple decision. It threatened entire financial networks. By the 19th century, government borrowing was no longer just about funding wars or infrastructure. It was embedded into markets, institutions, and cross-border finance. Debt didn't just support governments, it supported the financial system itself. In the United States, the early 20th century introduced another layer. Financial crises exposed how fragile decentralized banking could be. The response was the creation of a central banking system designed to stabilize markets, manage liquidity, and act as a lender of last resort. With that came a powerful new mechanism, the ability for central banks to purchase government debt using newly created money. This fundamentally changed the scale of borrowing. Governments were no longer constrained solely by private savings. As long as confidence held, bonds could always find buyers. Debt could be rolled over rather than repaid. The system became flexible but also dependent on continuous expansion. Later, during periods of high inflation and global instability, international institutions stepped in to manage sovereign debt crises. Rather than allowing widespread defaults that could destabilize global banks and trade, debts were restructured. Payments were extended, interest adjusted, and new loans issued to service old ones. This prevented collapse, but also ensured debts rarely disappeared. They were transformed into long-term obligations. Over decades, this pattern repeated. Governments borrowed to grow, stabilize, or survive crises. When debt became too heavy, it was refinanced. When markets wobbled, central banks intervened. The goal was stability, but the outcome was permanence. Today's system depends on debt to function. Government bonds underpin pensions, insurance portfolios, and financial markets. Paying all debt off would contract the money supply dramatically, risking severe economic disruption. So debt persists, rolls forward, and grows alongside the economy. Interest payments now represent one of the largest ongoing transfers in modern economies, from taxpayers to bondholders, from labor to capital, from public revenue to financial assets. This isn't hidden, and it isn't illegal. It's structural. The paradox is this: debt is treated publicly as a problem to solve, yet privately as an asset to protect. Every dollar of government debt is someone else's savings. Every reduction threatens balance sheets. The system relies on confidence that interest will continue to be paid, even if principal never disappears. This didn't happen overnight. It wasn't planned by one group or one era. It evolved through incentives, crises, and solutions layered over centuries. Each step made sense in its moment. Together they produced a world where debt is not a temporary condition, but a permanent feature. Understanding this changes how you see national debt numbers. They're not just warnings. They're indicators of how modern economies are structured. The question isn't whether the system can eliminate debt. It's whether it can function without it. And that's the reality most people are never taught. Debt isn't simply a mistake or failure. It's a foundation. And interest is the price paid to keep the system running. If this reframed how you think about government debt, then you're starting to see how modern financial power actually works, not as a secret plot, but as a structure built over centuries, maintained by necessity, and understood by very few.